Welcome to the Haleon Q&A session. If you are online, remember you can ask questions via the online platform. And then if you are in the room, please just raise your hand. And with that, shall we start to take questions from the room?
Yes. Guillaume, by the way, I'm gonna select who does Q&A. Very hard. So many of my favorite people in the room. I'll do my best.
I'm flattered. Good afternoon, everyone. Guillaume Delmas from UBS. Couple of questions for me. The first one on your 4 to 6% organic sales growth guidance, which was reiterated today. Because we've heard about driving penetration among low-income consumers. That sounds incremental. We heard about reducing the gap between incidence and treatment. Doubling down on premiumization. I mean, all this is pointing to an acceleration in volume mix. Would that be a fair assessment? And keeping the 4 to 6% organic sales growth guidance unchanged, does it mean you'll be relying maybe a bit less on pricing going forward, or you're simply thinking more the top half of the 4 to 6 rather than the bottom half? And then the second question on EPS growth. Why no guidance on EPS? You're targeting high single-digit operating profit growth, unless you're assuming significant changes in tax rate or interest rates. I mean, should that lead to a low double-digit 10 to 12% EPS growth in constant currency over the next 5 years? Thank you.
Great. Thanks, Guillaume. So listen, I'll take the first question, then I'll pass to Dawn on the EPS question. So listen, I think if you look at what we laid out and what underpins my confidence in continuing to look at 4 to 6% growth over the medium term, I think on the incident versus treatment gap, we do see significant opportunities. It's also the place that has driven growth on the business in the past. And you've seen that in Sensodyne, and as you heard about Sensodyne in the US. Premium-led innovation is something else I think we've been very good at in the past. We continue to see opportunities, and more opportunities we're going to go after. You're right that the new kind of incremental opportunity to what we've done in the past is the low-income consumer. That's not an area we really have strategically focused on in the past. We really see it as a great opportunity. Also, as you think about that consumer in emerging markets and the fact that they are going to become middle-class consumers one day, it's really building the brand equity now and brand loyalty, and then taking it into the future. So listen, all of that in the world that we live in the uncertain environment gives us the confidence to continue to commit to the 4 to 6% growth, because we see those growth opportunities. We have plans behind this on what we're going to do and what we're going to roll out and when we're going to roll it out. So, so I think the 4 to 6% we're confident in. I wouldn't give you high end, low end, middle end. I mean, but it just underpins our confidence overall. Dawn?
Yeah, and I think, look, in terms of the EPS, I mean, the reason why we're focusing on high single-digit operating profit is in terms of the quality of delivery of the EPS, and we really want to make sure that that's coming through the P&L. Yes, if you look at the other elements, given that we have strong free cash flow, over time you might expect that interest cost to come down, everything else being equal. Tax rate, maybe, let's see if it stays at the 24% it is today. And obviously what you've seen over the last 2 years, what you'll see the impact of this year is also the impact of the reduced share count as well. So that would be how I would think about EPS. So yes, driven by really strong high single digit OP at constant currency, and then you've got those other pieces on top.
Great, thank you. Right here. Yeah, that's you. No, I'm pointing. Yeah, absolutely.
Yeah, just a couple of questions. Going back to the top line guidance, first of all, could you give us perhaps a bit of an update on the RX to OTC opportunity over the coming years? And then just going back to the guidance on the gross margin, what's your underlying assumption for input cost inflation?
Okay, I'll go to Dawn on the inflation question. and I'll go to Frank on RX to OTC switch, but just a reminder of what we've said in the past. So 3 years ago at our Capital Markets Day, we had 2 RX to OTC switches in the pipeline, potential launches in 25 and 26, not in our guidance from an organic sales growth perspective, but in our guidance on profit because we'd be investing in those things. There's been a delay in both of those, but maybe I go to Frank and you can talk a little bit about what's happening.
Yeah, exactly. So we still are working on the one we have already mentioned a few years ago. As you probably heard, the environment in terms of regulatory is moving, changing, and we need probably to understand a bit more what the new administration will also unlock or bring as a new regulation. As an example, end of this month, we will have a new rule, which is what they call additional condition of use for non-prescription. We need to understand a bit more how that could unlock further the access to self-care. Clearly, the new administration says they want to promote more the self-care access. So we'll have to observe a bit more how the regulatory environment will move. Obviously, we have still our 2 assets that we have already shared in our pipeline, and we will check again if there are more to come regarding the evolution of the regulatory environment. But as the brand said, it's on top of the guidance in terms of growth.
Thank you, Frank. Dawn?
Yeah, and I think I think if you think about the gross margin and the gross productivity savings, our assumption is around about 2% inflation. That if you think about that chart that I showed, that be covered by price. The other way to think about it in terms of the 800 million, today our COGS are 4.4 billion. That's roughly split around 30% raw materials and packs and kind of 70% kind of the rest of manufacturing costs and other. So the inflation, will hit the material and packs piece and obviously, some other elements in terms of labour. But as Namrata talked about, we would look also to cover that through all of the procurement initiatives that she mentioned. And then within the manufacturing piece and the remaining 70%, that's where all the other initiatives would come through in terms of the operational excellence, the complexity reduction, etc. So that's the way I would think about it.
David? Hayes?
Hello. 2 from me, if I can. One on organizational structure and then one on manufacturing. So on organizational structure, you hear some of your peers talk about changing that. What is the best optimal structure? So just to understand, is it a matrix structure here? Do the markets have a P&L, or is this all these initiatives driven by the divisions, and that's kind of where the initiatives are controlled as you bring in the new products innovation? And then on the manufacturing, it feels like you're saying there's too much contract manufacturing. You want to bring more of that in-house. Is that a function of the business and how it was created with all the 3 units, and you're now going back to address that? What are the benefits of contract manufacturing that you worry about losing? And with all the changes going on, to your point, you'll be busy. Should we expect we're going to get a few quarters where it's like, oh, we've got to turn off this plant and turn this system off, and we get a pre-ship, and then would it be volatility along the way, or do you think that's something you can manage and we'll never even see the join, basically? Thank you.
Great. So I'll take the org structure question, then I'll go to Namrata. By the way, I started my career in supply chain, so I could answer that one too. So on org structure, I think about it as an operating model in a way. So it starts with what you've seen, which is the Win as One strategy, which lines up the entire organization of what we're doing. Strategically, we think about the business from a category perspective. We have a category structure. As a leadership team, we look across the business and across the categories, and we make the decisions on big resource allocation that happens. Then that gets deployed down, and we have 14 business units, which are regionally lined up P&Ls, and we run the P&Ls in the business units. Now, why that's important is our go-to-market is consistent across all our categories, and our categories aren't of a similar scale of, let's say, of some of our consumer staple peers who run their business literally P&L top to bottom from a category perspective. So we think it gives us actually the right ownership at the local level with the right strategic direction coming from the categories on down, with resource allocation decisions made as an executive team on how we're going to drive the growth and productivity. And then Namrata on manufacturing. Thank you.
Yeah. Thanks for the question. I think in terms of the contract manufacturing network that we have a lot of contract manufacturers around the world that do small amounts. So on the one hand, that's good because we have some resiliency built in, but we also have capacity in our factories, which we want to maximize on. So one of our goals is that how do we have the balance between what goes to contract manufacturing and what do we do in-house? And we want to use the contract manufacturing network to do specialized kind of products. If there's a new trend, for an example, we just can't overnight invest in it, and we may not want to either. So that's our overall goal. But contract manufacturing will be very much part of our network.
Good. Thank you, Namrata. Celine?
Thank you. Céline Panutti, JP Morgan. So first question on the 800 million savings. I would like to understand the drop-through. So you said that there was some supply chain or OPEX supply chain costs. Where are those? Are they included in the gross margin or are they in the SG&A? And on the 50 to 80 basis point annual gross margin expansion, I mean, quick math, I think you would need at least 40, 50 basis point of EBIT expansion to deliver high single-digit EBIT growth. So that would suggest not much reinvestment in A&P as a percentage of sales. Did I get this right? My second question is on gross margin. So over the period, you expect 250 to 400 basis point higher gross margin. Is there a drag from the 1 billion new consumer at low income? And so what is that drag? And if I look at different category, where is the gross margin coming from? You already have, you said, I think, the best gross margin in the industry. So what will get you even higher there? Thank you.
Fantastic. So I'm going to actually pass those over to Dawn. But the first thing I just want to say about your question on the billion consumers, the billion consumers are not all low-income consumers. It is the part of the strategy which is new, and we're going to go after that aggressively, but the penetration in our core categories on brands like Sensodyne, even in premiumization, will also add to that number. But Dawn?
Yeah, I think that what I would say on the gross margin, I mean, you're right, we have a really strong gross margin today, so 63.2% last year, and actually delivering 50 to 80 basis points on average over the next 5 years. That's going to put us right at the top end of the pack. So I think that's really exciting. In terms of that gross productivity savings, I mean, that equals about 550 basis points over the next 5 years. If you then take off that, higher costs to deliver and investment in new capabilities, if inflation is offset by price, then you're left with the 250 to 400 basis points over 5 years, which is the 50 to 80 basis points. And actually, when I think about that, I go, that gives us huge flexibility. Actually, flexibility in terms of investment in A&P, investment in R&D when we need it. If I think about SG&A, if we're growing at 4 to 6%, we should get some operating leverage from that, which again gives more choice and flexibility about what we would invest in terms of whether it's digital or new capabilities. So I think I think that's our goal. We obviously want to deliver the high single digit, but actually the gross margin opportunity, which is significant, that gives us that optionality to dial up investment when we need it or invest in new capabilities as well. And that's really important to ensure that we can sustain that growth for the long term.
Thank you. Let me try to go in the back. Maybe you can bring the mic over there because I'm not going to be able to. Thank you.
Hi there, Jeremy Fialco, HSBC. So a couple from me. First one, when you're guiding from next year, will you be giving sort of annual guidance, or would you expect to be delivering this high single digits operating profit growth every single year, or is this simply an average over the period? And then the second one is on the SKU reduction. Do you think that that's going to have any impact on your revenues at all, or do you think you can get rid of this sort of 30% of SKUs with basically zero impact on your revenues? Thanks.
Great, thank you. First of all, on the guidance, we would think about this high single-digit operating profit at constant currency as an annual thing. Every year, of course, we'll give any updated guidance we would give like we would at the beginning of every year. On SKU reduction, in our guidance going forward, any SKU reduction is incorporated into that. But maybe Namrata can talk to a few places how we're doing that, because in many cases, that reduction is invisible to consumers. And actually, we don't think we will have a drag. And we also did reduce 13% last year in our growth that we already delivered. But Namrata, maybe a few examples.
Sure. Our goal is to focus on SKUs that are dilutive and that are declining in revenue quite significantly, so tiny amounts. One of the key things that we have, if I give you an example, on our toothpaste packaging, we have single languages. But if we go to multilingual, that doesn't necessarily mean that we will reduce in terms of our revenues, right? We will keep those revenues going, but have an immense amount of simplification. So we're confident that this isn't going to lead to any kinds of major revenue declines.
And listen, the reality is that, of course, there's some of that will be some risk in the top line. Well incorporated into our 4 to 6% guidance and eyes wide open. Next question. Let's go back there. Emma, maybe you can bring the mic there.
Supply chain. Sorry, it's James Edwards-Jones from RBC. Supply chain again. Can you expand a bit on how the supply chain retooling is going to reduce the currency mismatch, given that about, I think you said 80% of production is already local? And a more sort of fundamental question, I guess, about you spend about 7 times as much on A&P as on R&D. As a science-based organisation, have you given any thought to whether that ratio needs to fundamentally change?
Great. You know what? I'll take the first one, and I'll pass the currency question on supply chain over to Dawn. Listen, I think if you look at our R&D as a percentage of sales, which again 2.8%, 2.6% now, we do see the opportunity to invest more. Very competitive from a consumer company perspective and a consumer health company perspective. So, within that, all the science that Frank has shared and all those capabilities and clinicals are all incorporated in that number. So we feel like we have a good level of investment in R&D, absolutely. We believe, and we will invest more in R&D when we see and we have the opportunities to even do more in that space. But Dawn, on the question on FX.
Yeah, and I think, look, from a supply chain perspective, if you're thinking about a future network strategy, and Namrata talked about, some of the changes and the supply chain of the future, what you obviously need to incorporate when you're thinking about that is what could be the impact of currency. There are still countries today that are sourced, outside the country or from very different currency pairs. So I think the considerations to think about is, one, your future supply chain network optimization, that you're thinking about currency in that, and the other piece is currency pairs or currencies that move together, and the currency that you're invoicing in as well, are all the different factors to think about in terms of how we balance that mix.
Great. Right here. Emma?
Thank you very much. It's Callum Elliott at Bernstein. So my first question is actually for Tamara. We heard a lot about how you're using marketing to drive category growth in your presentation. But Dawn, I think in her presentation, touched upon how marketing is also an area where you're going to need to focus on efficiency. So maybe I'm just hoping that you can flesh out from kind of inside the marketing organization some details or give us some examples of how you're going to get a better return on ad spend at a time when I think Google announced ad pricing up 10% in Q1 this week. I think Meta ad pricing was up 10% in Q1 last night. Doesn't really feel like an environment that's particularly conducive to driving efficiency in marketing spend. And then I have a second question, maybe for Keith. We saw the video about India earlier, the great success that you've had since taking back control from Unilever. My question is, I guess there must have been a decent chunk of upfront investment building out infrastructure ahead of that change. I assume that infrastructure probably skewed to fixed cost investment. So would it be right to expect that we can now expect accelerated profit growth from India as well as the strong revenue growth that we've seen over the past year or two?
So listen, we'll go to Tamara first, and then we'll go to Keith. Just one comment on India. One of the reasons that we took distribution back from Unilever was two reasons, actually. One was a strategic reason. We compete with them, and we felt like we have a business that we needed to drive on our own. But it was quite a fixed cost percentage payment we paid them, and it was quite high by any benchmark. So actually, quite efficient for us to bring in to bring that in, and also strategically made a lot of sense. But there's a lot we're doing in India to drive growth, and Keith can mention on that. Yep. Tamara, do you want to go?
Yeah, sure. So we feel very confident in the amount of AMP we have and the way that we spend it. We have a great partner in one of our media buying agency where we've worked to make sure that we have a contract that helps us somewhat offset some of that inflation. But we're focused on both efficiency, the buying, the cost, the spend, but also on effectiveness. So one of the things we've been doing is we're continuously using data and analytics, doing market mix modeling. We do that across 70% of our media spend with an ambition to keep on increasing that. And as we're doing those MMMs, we're seeing big jumps in our ROI. So we've gone from 1.2 up to 1.4. We're really clear around the role of the different channels, getting really good ROIs on those channels. We've reduced the number of campaigns that we run. So we used to run quite a lot of small campaigns. We've reduced by 23%. What that means is we're able to really focus on doubling down that investment, expanding the number of channels that gives us both fantastic reach, but also the depth so that we're building both short-term sales and long-term healthy, strong brands. So we're looking at all of that. We look at programmatic. We look at making sure that we're not getting a value drop between demand side and sales side in programmatic, so that we're really getting transparency into those media supply chains, and we're really confident that we are investing money that is getting into the consumer and driving that conversion to purchase.
Keith.
So on the India question, as Brian just now mentioned, right? In fact, we are more cost efficient under our own hands. So apart from cost efficient, I would say also the effectiveness. So post this model, when we take back our distribution, our sales force, basically, in fact, our coverage doubled because of this. And this will give us also more, attention in terms of effectively even going to the lowest tier cities. So now basically with this, change of the model, we are able to even unlock, the growth opportunities. For example, you heard about regarding the Sensodyne, right? We still have a lot of headroom for growth in the lower tier cities. And now we have really had this 20 rupees or 20 pence, okay, access pack. Now through our distribution, really can able to penetrate to those lower tier cities. And similarly, for the central recharge, I share in the regional breakout section, that is really, again, how we can really now leveraging our distribution sales force to really penetrate into the lower income group to unlock also the growth potential. So this is really, I say, a great kind of like a distribution strong, route to markets. We build the muscle, but in particularly the existing brands as well as the new innovation we bring in. Second piece is also the expert marketing. The expert detailing is very important drivers or also our building a superior brand. So now with this, basically we also really have a lot unlocked, of the growth potential. And that's why in the Q1, we continue to grow above market and also we continue to have double-digit growth for India business.
Thank you, Keith. So I understand we have a couple of questions online. Maybe we go to one of those?
Yeah, I'll take them individually. So first of all is, could we talk about tariffs for Haleon?
Okay, we can talk about tariffs. Listen, I'll pass it to Dawn on the tariffs.
Yeah, I think, look, in the US, I think that for us, tariffs, based on what we know today, are in the tens of millions, and that is obviously fully built in to our guidance. 80% of what we sell in the US, we make in the US. And yes, the tariffs have shifted from kind of finished goods impact for Canada and Mexico more to a global impact. It also incorporates raw materials and pack, but actually the impact's the same. And, I think I said on the call yesterday, when we think about tariffs, we think about it through two lenses. So yes, there's the mitigation lens in terms of how do you mitigate any on cost. The other lens is actually an opportunity. So how do you leverage it to get an even stronger relationship with your retail partners? Does it unlock competitive differences or shifts which actually you can then unlock? So I think for us, yes, we obviously monitor the situation, we mitigate it, but we also think about, is there an opportunity here as well?
Great. Okay, back in the room. Right there, am I here?
Thank you. Good afternoon, Tom Sykes from Deutsche Bank. Firstly, just on they're all on gross margin, sorry. Do you have what the history has been on the current sales perimeter for constant currency gross margin improvement to compare against the 50 to 80 basis points? And then does the 50 to 80 basis points include volume leverage? Because presumably your incremental gross margin, if COGS as raw materials as a pass-through, is up sort of 70, 80% or so. And then I don't think you answered the question on mix, just whether you thought mix was a positive or negative to gross margin into that 50 to 80 basis points, please. Thank you.
Okay. All right. So there's several questions in there. What I would say in terms of moving forward versus the history, I think Namrata talked about it. What's important for us moving forward is actually our starting point is different. So versus many others. So we're not necessarily coming from a low base in gross margin. Actually, we've been pretty good in terms of gross margin. But on top of that, we see significant opportunity moving forward, as we've outlined. I think in terms of the volume leverage piece, if you think about what I talked about in terms of total COGS costs, so 4.4 billion, 30% coming from raw materials and packs, 70% from manufacturing costs. If I then think about the savings against that, if I think about the 800 million against that, think about that in proportion. So as I said, procurement savings on raw material costs. If I then think about the 70% for manufacturing costs, think about that maybe broadly equal across three buckets. So one bucket, complexity reduction. So Namrata talked about more languages on pack, harmonizing packaging, reducing the number of SKUs. So complexity reduction is not linked to volume leverage. It's just removing bad complexity and simplifying our supply chain, our manufacturing processes, and actually our end-to-end value chain. So that will be the first bucket. The second bucket is around operating efficiency. So getting more out of our plants. So this might be a tweak to a piece of equipment. It's debottlenecking it. It might be separating heating and cooling in a process. So it's improving the performance. It's getting more out of the assets that we have and really driving them. What does that do? That unlocks more volume. So in theory, not only are those assets being more efficient, you should be able to get more volume through it. So that's where you get operating leverage benefit. And if you weren't getting operating leverage benefit from volume, then you would need to look at the cost. So I think about that. And then the third area is around the network optimization. So this is around the contract manufacturers. This is in how do we optimize that in-house versus out-of-house. So I think the volume benefit is built into some of those elements in terms of the cost saving piece. And I think the last question in terms of mix. So obviously, we are managing a complex portfolio across different geographies, across different categories, across different packs. And optimizing that mix, whether it's coming from premiumization, whether it's coming from price pack architecture, whether it's coming from net revenue management, that's something that we do. We're managing that all the time. If we have some things that are margin dilutive in the short term, we will look to balance that, with something else, either in country or in a different country. And so the mix piece, that is built into the 50 to 80 basis points of gross margin improvement.
Thank you. Right there, Emma.
Yes, thanks very much. Edward Lewis from Redburn Atlantic. I just wanted to ask about the opportunities you talked about tomorrow, particularly in the emerging markets. And I think I was struck by how you're taking the price premium that you've got, I think it's 120 index, and you're taking those brands into those markets, which I think we can often overlook how, I guess, aspirational consumer can be. And what does that mean to the competition you face? How much competition is there? And so how much opportunity do you have to grow the category sort of probably faster and take share with that regard? And then, Brian, just on, I think 3 years in, I guess, since the spin, in terms of the culture, I think many of you on the stage have come from different companies. You talked about being 3 companies put together over 3 supply chains. So just talk about, I guess, how you feel the culture of the company is developing over the next 3 years and the opportunity you see there.
Great. And so I will answer that question first. Then I'll go to Tamara a bit, but then maybe to Filippo to talk about what's happening on the ground in some of the emerging markets that he manages. So listen, I think we've made great progress as a company around culture. And let me just tell you how I think about culture and define culture, because I think about it pretty broadly. I think it does start with having an organization that's completely aligned and lined up to the strategic intent of the company. So you saw our Win as One framework. That is embedded throughout the organization. I can tell you that there was most of the organization online today for this Capital Markets Day, and they see that that is consistently something we're sending out into the world. I think second, you have operating model and how you run the business. The truth is, it's evolved for us. When I talked earlier on the question on, how does it kind of work? We've evolved to be a much more strategically driven by categories versus being a P&L run by markets. So probably started this journey more bottom up And now we're getting much clearer on those headroom for growth and making much bigger strategic choices across the business. Then I think there's talent and capability. And on talent and capability, we've changed the talent quite a bit in the top 3 levels of the organization. And I feel really good about how we've kind of increased that talent level. And, we see it in our engagement results. We just had an engagement survey just a few weeks back. 82 or 83% engagement. Yeah. We're in kind of top quartile engagements. And within that, we still see, opportunities. So one of the opportunities is, let's say, quote unquote, paraphrase, it's easy to get work done around here. It's not as high as it needs to be. And that's my last piece, which is processes and systems. And I think it's the place where, again, we've made progress. We have Haleon Business Services. We're going to go further. We're not where we need to be. There's more to go after there. And I would say on the entire culture journey, think about how you transition into a world-class consumer company that's agile, that's consumer-centric and performance-focused. We're 6 or 7 out of 10. We're on the journey. We feel good about it. We're very clear on what we need to do, but there's definitely more to go after.
Great. Yeah. So starting with our penetration. So our penetration with high-income consumers is around 30%. It's around 17% with low income. When you go to some of the emerging markets, that gap actually widens even further. So it's really clear that there's an opportunity here. We did loads of big studies. Half of the world feel like they're able to control their health. Other half of the world don't feel like they're able to control their health. Doesn't always mean that that's the emerging markets, actually. We see quite a lot of that in other parts of the world too. But what is clear is that 45% of low-income consumers would describe their health and wellness as good or quite good. That's 65% in the higher income. So there is a real opportunity. In terms of competition that we face, often it'll be traditional home remedies. Sometimes you see some of the usual players in these markets as well, but the majority of the time it is things like home remedies. And if you think about pain, 9 out of 10 people on the planet will suffer pain. Up to 10 times, 10 different types of pain. And that's also true for the lower income consumer. And one of the things that people are incredibly focused on is the ability to continue to get to work, to be able to do their jobs. And they do not want to be held back by their health, and they want to provide for their family. And so making sure that we're driving that health literacy, the understanding of what is the condition I have and what is the best way of treating it. And that behaviour change is something that we're very expert at Haleon. The Sensign model is a very good example of condition awareness. This is your issue. This is your solution. So making sure we then do health literacy in the right way, icons on pack rather than written language all the time, so you can understand what this pack is and what I buy it for. So we see a lot of opportunity to take all of our categories into this lower income consumer and have a lot of confidence in the plans that we've got there.
Thanks, Tamara. Filippo, anything to add?
Yeah, maybe I can add a couple of comments to what Tamara said. On the brand piece, so clearly we discussed a lot about superior brand, and what I see in all of the emerging market is that the concept of brands first is really important because the appeal and the aspirational element you alluded to is absolutely key. And I think we have 2 interesting examples in that space because we saw this morning the example of Centrum Essencial in Brazil, which, because the vast majority of the buyer of the product are new to the category itself, which is a powerful signal that the brand equity is strong, there is a significant attractiveness, and these people are new to the category, so it's an opportunity to really expand the category penetration. I think another example about the lower income consumer not in emerging market is a fantastic brand that we have in Italy, which is called Betotal, which is a quite expensive VMS brand, and is over-penetrated among lower-income consumers. So it's not that the correlation is always as linear as we could imagine. I think from a competition standpoint, we have a very diverse competition. In the breakout session, I explained very well that the launch of Sorridor and the entry point SKU, which is positioned at an affordable price. I mean, we are targeting a local competitor, which is a local player, which is the number one in that at that price point. And we believe there is an opportunity to really bring the benefit of the brand plus the scientific element of differentiation at a price point which will make it competitive. On the other side, and without naming any other competitor in the oral care space, we have a lot of example of price steering which are covered quite in depth from our competitors, and we see that also what we have been doing, especially with Sensodyne, has been giving us quite a meaningful payback.
Great. Thanks, Filippo. Why don't we go, Emma? Why don't we go there, and then we'll go next. Yeah.
Thank you. Hey, Rashad Kawan from Morgan Stanley. A couple from me, please. You talked a lot about consumer insights today driving investment decisions, particularly in categories like VMS, oral care, et cetera. I guess comparing where you are today versus 3 years ago, pre-spin, how evolved are your consumer insight capabilities and how much more room is there to go? And then second question, as part of your EBIT guide, you talked about managing dilution from divestments better going forward. You've obviously done a few divestments over the last couple of years. How do you think about the portfolio as constructed today? And in terms of M&A, you've spoken in the past about VMS in particular being an attractive category. From an M&A perspective, is that still the case, or have your thoughts kind of evolved around categories in which to expand in?
So we'll start with the second question first. Let me provide some perspective. I'll pass it to Dawn, and then we'll go to Tamara on the other. I think, listen, in the early life of Haleon, as we started life 4 times levered, we made the decision to divest. By the way, strategically, the right businesses to divest, and it helped strengthen our portfolio. It also helped us pay down the debt. We weren't in a position at that point to do bolt-on M&A. So those divestments, and you saw it in the bridge that Dawn showed on operating leverage, actually we lost operating leverage, obviously, because those were dilutive. And that showed through 24, and we have some more dilution this year. So I think it's an acknowledgement that going forward, we're going to manage that dilution going forward. If we see opportunities to divest, marry it up with bolt-on M&A. We feel good about the portfolio and where we're at. Any portfolio can be strengthened on both sides, bolt-on M&A and potentially divest, but there's nothing where we're sitting down feeling like we have an urgent portfolio change needs to happen, but we're going to be in a different position to be able to manage it going forward as we think about strengthening the portfolio.
No, I don't know.
Did I do it all?
Yeah.
Sometimes I do that. I say I'm going to pass it to you, and then I answer the question.
I love that.
By the way, I also have an MBA in finance.
That's brilliant.
I do remind Dawn.
I believe one day you were a brand manager as well, Brian.
Well, I was. I was Tide brand manager at one point. Never been as good as it was back then. But Tamara, how about you?
It certainly was fun back then. Big shift, I would say, from where we were 3 years ago. Consumer first always is one of our. Please do keep chatting. Consumer first always is one of our kind of key behaviours. I would say 3 years ago we were really proficiently deep in things like condition awareness. So really understanding the medical, the health issue, how that left somebody feeling. And we had great kind of market share data and coverage. I think where we have evolved is to really understand the consumer really around that condition and what's happening in their world and in their lives. And even things like crossover of studies, so real world evidence that Frank and I talked about earlier, that is not in a lab, that's not a clinical trial, that's actually collecting data, often digitally, in terms of how are you using these products, what are the benefits you're getting. That's where we learned all about Otrivin. And actually people were so thankful to be able to sleep through the night without being woken up because they just couldn't breathe. So you get a whole load of richness there. That enabled us to go back and mine our kind of claims database around what is the most powerful and compelling claim for that new premium innovation that we launched. So I think we're deeper around the consumer. And then I believe we are the first to do this, which is we've done some demand space work where we're looking across. So not just what's happening in oral health, what's happening in pain and in respiratory. We're actually looking at what are the real wellness issues that the consumer is facing and what are they really worried about. How does that differ from developed markets, emerging markets? And again, a first in the US, and we've had feedback here from the retailers in the US because they've taken the demand space work down to the next level to really understand cross-purchasing and are now working in partnership with retailers to really think about how do we bring the portfolio to life in the most relevant and meaningful ways. So I think it has quite considerably changed, and it gives us even greater confidence that we're understanding what the consumer needs are and then how best to meet them with our products and innovation.
Great. Thanks, Tamara. Mahir, yeah, thank you.
Yep, hi, it's Warren Ackerman here at Barclays. Got a couple as well. The first one, I guess for Brian, it's more on the global brands versus local brands. I was quite struck, it was the beginning of the day, but your new divisional disclosure to give us sort of skin health. You talked about brands like Zavirax. And at the same time, you know, in the breakouts, we heard a lot about local brands like Grandpa in South Africa. So I was just wondering, are these kind of linked? As you're getting bigger in emerging markets, do you need to have a portfolio of more local brands? And I heard you also saying at the beginning of the day that your power brand strategy has been evolving over the years. So can you maybe sort of join the dots and all of that for us in terms of the skin health and then what it means between local and global brands? And then just secondly, I was quite struck by the pharmacy sort of presentation. It seems like you do have a big moat. Can you talk a little bit more about how you can really maximize that channel? It'd be great if you're able to kind of give us an idea of which geographies is pharmacy more attractive than others. I guess it's not the same everywhere. And whether actually it will be accretive to your gross margin ambitions as you kind of dilute the drug channel, which is obviously under pressure. Thank you.
Great. Listen, I'll go to Filippo on the pharmacy, but let me take your first question first. So the way I think about that is if you look across our 6 categories, and I'll talk about skin health in a minute, and I think about power brands, the 9 power brands. We traditionally have been very focused on the power brands. We're still going to be focused and drive those power brands. What I don't think we've done as good a job enough is leveraging the full portfolio, honestly, and you heard a little bit about it today. If you think about leveraging the scale of innovation, technologies, assets we have, Sanrador in Brazil is a great example. That's a brand that was less than £1 million probably in sales, wasn't a priority for anybody. We have brands around the world like that already exist. It's not like we need to bring in more brands, but I think we are now seeing with the opportunities and the headroom growth we have in categories, we now can leverage the breadth of our portfolio. A lot of times, honestly, you can look at those kind of assets and think about it as a tail or a drag or something. And I think our aperture has been opened up to say, wait a minute, we have incredible assets in a number of places. And obviously we haven't been leveraging them as much. Now, the evolution of our category strategies getting sharpened, our operating model shifting a bit more to the top, all that has kind of come together to drive that. Specifically on digestive health and skin health shift, one, we wanted to provide more visibility and transparency across the categories we compete in. We think digestive health is a really good category. Skin health, this is therapeutic skin health, and that's what we're calling it. They are OTC brands that line up with our go-to-market model and our strategy. They're really good profit the brands for us, honestly, very good gross margins. And we want to generate value through that too. It hasn't been a focus for us as much in the past, but we see the opportunity to drive value through therapeutic skin health. And then Filippo?
Yeah, I mean, what I did is, if you remember, I started the presentation by saying that pharmacy channel is relevant for consumer health and for Haleon. Now, this is true today, but for sure it has all the potential and the elements to be true in the future. And there are few reasons for that. So first of all, if you think about this whole gap between incidence and treatment, the pharmacy institution in itself could play a massive role in order to really keep engaging with consumers in understanding which solutions could be available for them to fix this problem. Second, if you think about the concept of self-care, is relatively underdeveloped yet, even in Europe, for instance. And there is a massive opportunity to really find the right equation to reduce the burden on the healthcare system at the national level and increase the role and the relevance of self-care. Third, I think there is a clear opportunity for improving effectiveness of the pharmacy channel. I think you saw the statistics on Perfect Store. I mean, at the end of the day, thinking of being able to allow the category to grow 2 to 3 points ahead of the average is massive. And this is a lot about improving the effectiveness of the operations in the store, thanks to the support that we could provide to the pharmacist. There is another element which is also about the harmonization. So again, think about Europe. There is no one Europe, because if you look at the pharmacy setup in the Nordics or in the UK compared to what we have in Spain, in Italy, or even in Germany, is totally different. And we believe there are massive opportunities to potentially harmonize some of these elements to bring to make the product become more accessible and more interactive for the consumers. In all of that, I think the key effort that Haleon has been making is really to play on this dimension, because we really invest a lot in expert education. We invest a lot in commercial capabilities, effectiveness to the customers, and this is recognized back by them. So this is why I do believe the opportunities for the future are still relevant, even in a channel which has been transforming for a while now.
Mark Howden.
Thank you. Mark Howden from Jefferies. Obviously, I'm not clever enough to ask my own question, so I'm going to steal Del Boy's. When he talked about top-line growth, and when you answered about top-line growth, you didn't go so much into the volume mix part of his question. And it occurs to me that we've heard so much today about the opportunity with low-income consumers, penetration in various parts of the world in various categories. It feels like there is a tremendous volume mix opportunity ahead of you. I think on the call yesterday, we talked about balance and no more. Is there any more you can say about the volume mix opportunity and whether it can accelerate from here and be a bigger part of that 4 to 6?
Yeah, listen, we probably won't guide on volume mix. And we have always said 60-40, 40-60. But clearly, if you look at that low-income opportunity, and listen, that will build over time, right? As you can see, Somridor launched in Brazil this year, Centrum in low-cost Centrum in India this year, 20 rupee pack in India was in June of 2024. These things will take a bit of time to build, but I do see the volume kind of mix opportunity as you look out the next number of years as a really good opportunity for us. Because again, these are incremental consumers into the franchise. And a lot of this, by the way, we talk a lot about gross margin from a percentage basis, dilutive or not dilutive, but let me tell you, incremental gross margin pounds, these are incredibly incremental to our business in the 70 to 80% versus, let's say, you do a great innovation and maybe it's 30%. So we do see an opportunity as we look forward. But I would say over the next few years, we're really striving for the balance that Dawn talked about, 40-60, 60-40. And then, we see more opportunity as we look further out.
And I'll just give a data point on that, because actually if you look at our Asia Pac region over the last 3 years, the CAGR in Asia Pac has been 8.5%. 6% is volume. So actually, there are parts of our portfolio in particular. If you think about the Asia Pac region, maybe there's about 65% that's faster growing markets, the remaining 35 lower growth markets. But the fact that, more than 70% of that growth is coming from volume actually exactly speaks to the opportunity that we're talking about.
Great. Yep.
Hi there. I was curious to hear a bit more about the capital allocation strategy on maybe a year 3, year 4, year 5 from now? I think in the near term it's pretty straightforward if I'm not just shooting with you directly. So could you just talk a bit more about the dividend policy, share buybacks, capital investment, M&A? I imagine bolt-on may not be there forever. And so, maybe can you take me in the lens of year 3, 4, 5? Thanks.
Yeah, so look, as I said in the presentation, our capital allocation policy is unchanged. So invest for growth, bolt-on acquisition, return surplus cash to shareholders. We've returned, £1.5 billion of surplus cash to shareholders over the last few years or since demerger. So I think what we've demonstrated is actually, and what we do is look at each year what is the most optimal use of those funds, what is going to generate the highest shareholder value. We did that, at the beginning of this year. We're obviously in a privileged position given our strong free cash flow generation. And obviously, what we decided at the beginning of this year is that we would return £500 million in share buyback. But we will look at that each year in terms of what's the most optimal use of that cash based on those 3 priorities.
Okay, I actually think we're at the point for the last question. It's going to be the last thing I remember from this day, so no pressure. Or did we literally run out of questions exactly on time? Do we have a question from the online that we want to take?
We've got one, and then we can. So, can you discuss the ability to reach more lower-income consumers in the US, given the higher share of private labels in this market?
Okay, great. Well, first of all, people may be aware we have a new head of North America, Natalie Jersten, who joined us from L'Oreal. Today's her first day. So what you're not really aware of is this was all about Natalie's onboarding, to be honest with you. We planned this whole thing for her. Listen, there is an opportunity there because the dollar channel is a very important channel for us. And what you see happening in the U.S. a bit, as certainly as people are under economic pressures, is growth in that dollar channel and growth in the club channel, because they kind of attack it from 2 sides. One is a cost per use kind of thing if you're more affluent, and the other is absolute price outlay. So we see the low-income consumer in the U.S. too. We obviously are doing that today, but there's probably more opportunity for us to go after there too. So listen, that is the end. So first, just want to say a big thank you for everyone who's here in the room in London for joining us in person, and a big thank you for everyone who joined us online. I really look forward to keeping you all updated on the progress of everything we talked about today as we unlock the potential of this business. And for those who are here in London, we'll have a reception now behind that wall, and I look forward to interacting some more over the next hour or so. Thank you very much.